was a good week for the markets. The S&P was up 1%, finished the month of May up 0.5%. Small caps and NASDAQ up 2% for the week. The 10-year bond finished at 1.59%, so the bond market has been well behaved. And international markets were surprisingly strong throughout the month and closed near their highs.
So pretty much no surprises this week?
Not really. I mean, we're still digesting a lot of the economic data. For example, we saw that jobless claims came in better than expected, 406K versus 425 estimates, so that's good, the lowest level since the pandemic. We got a mixed reading on durable goods. It was a miss, but if you take out transportation, it was more or less in line. Consumer confidence still remains fairly buoyant. So generally speaking, the economy continues to improve. The other big change we saw on the economic front, if you will, is the Biden proposal for the $6 trillion budget. We're talking about big numbers on top of what we've already spent. So a lot of fiscal stimulus coming our way. Of course, that's going to be negotiated over time. And we also heard a little bit about tax increases as well.
If you've been listening to the show for a while, you've heard the phrase sell in May and go away. Here we are sitting on the 29th. Is there any evidence that this thing still happens? And does this go back to the 2030s, 40s when traders would leave town?
Well, I think that might be the case. I mean, you can torture data any way you want, and basically, historically, if you sold stocks in May and didn't buy them back until October 31st, you generally realized all of the returns from the stock market going back 100 years. But as that became wider and wider known, it became less and less effective, as are all things that have been back tested. But what I would say about that is, June is the second weakest month of the year after September. We are entering June on a fairly high note. There is some uncertainty out there about inflation, about valuations, about what the Fed's likely to do. So it's possible we could see some volatility and some sideways market action for a while because we've had a huge advance since last March.
When you're hanging with your crew and you guys are discussing finances, is there more discussion on the market or is there on the impending changes in taxes?
Up to this point, I think the market is seeing the positive benefits, right? It's seeing the stimulus. It's seeing all the monetary accommodation. It's seeing the recovery and the reopening and all the enthusiasm that generates. But ultimately, we do have to pay the piper. And those tax increases are coming, the magnitude of which are still unknown. That's to be negotiated. But clearly, that will be a headwind for the equity markets and the fixed income markets in the months and years ahead.
In the past, you and Dave have talked about Main Street versus Wall Street. Can you break that down?
Well, what we typically mean by that is, Wall Street, when we think about that, we think about, say, Donald Trump. He talked about the stock market all the time as sort of a referendum on his policies. The Biden administration is much more concerned with the middle class and workers and worker wages. Janet Yellen has said as much. Jerome Powell has said he wants the economy to get back to the prior levels pre-pandemic, which means an unemployment rate closer to 4%. It means GDP growth above a certain level, and we're not there yet. So they're going to let the economy run hot, and if higher rates lead to a pullback in the stock market, a correction, or even a bear market for some period of time, I think they'd be willing to tolerate that, provided wages start to increase.